The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Hello everybody, this is Coach D with TackleTrading.com, here to give you a market update, a little bit of a recap of what we've seen this morning. The S&P, I'm looking at even the S&P futures, has actually given up a little bit of the ground it's gained this, yesterday. Trading up into resistance, and we're seeing a bit of a downward move. Now keep in mind, we typically see the big moves in the morning. We don't normally see big moves or whatnot in the afternoon. We could see that, but it's kind of banging on the door up there. Little overextended range-wise as we get into there, and it's coming in on lower, weaker volume. So if you kind of look at the volume down here, volume's waning. Price action of the candles is not surprising. It's shrinking candles, lower range, slowing down, slowing momentum into that all-time high. And, this could turn into a cup and handle type scenario where it dips a little bit and then repowers and breaks out. It could be the type of thing where resistance holds and it's more of a topping pattern. Keep an eye on it though, but not surprised to see it retrace here a little bit. And if we change that time frame, we go intraday on that, drop down to say 30 minutes or so, you should be able to see there that we have a double top. So we got that M for murder double top, and we'd watch for those first levels of support to break. We broke through the first level, got a second level, it's violated the trend zone, and that's typically where you'll see a little bit deeper retracement. If we do get a retracement, one of the things you can do is go get a Fibonacci retracement and measure the extent of that wave. So we can go from the low back here to the high. It doesn't matter which time frame you measure on as much as it is that you get the major pivot point, the start of that run, the end of that run. So we can get that up there, and it's not necessarily going to be the Fibonacci ratios where it retraces to, but after a good healthy run, a 23.6% retracement, if it gives signs of reversal from here, that's actually a good sign for bullishness. Down to 38.2. If it dips deeper than 38.2, then we'd start to expect that it's not as strong as a bullish retracement. If it starts dipping down into the 61.8%, et cetera, et cetera. So if we drop that back out to a daily time frame and look at that from here, from this perspective, you're really looking at it from a see where it kind of matches up with support and resistance windows. Let's see if we can kind of get that. Bam. So that, the first zone does coincide with some of these older support resistance zones back in here. Second zone coincides with some of the support here. You got some back here, little guys. And it doesn't match up perfectly. You got a little bit more of a minor one. 618 comes down into one of the bigger zones, and you see that the double bottom hammers all the way down. So, those, it's kind of like a trampoline more so than an exact zone. But that's a little ballpark for us. If we do see a retracement, I'd actually expect it to come into the first zone and stay above 2100. In this case, with the S&P, the fibs are just one little tool that I use, but I also keep an eye on the big fat numbers, just 2100, 2050, 2200, et cetera, would be a big resistance zone. So just keep an eye on those even fat numbers and watch the market carefully. Let's take a look at the NASDAQ/NQ. And NASDAQ, I'd expect it to retrace, and it's been the run, and it's extended a new high on good momentum. Volume's been unimpressive, but again, keep an eye on it so we can see if that'll turn into but I definitely right now expect it to retrace based off of seeing it overextended. Range up. So let me kind of identify the concept of range up for you here. So you can go to the drawing tool, and I'll use these from time to time, grab a little rectangle box, and go measure a pivot from bottom to top, a swing, a wave, a range. And you can measure any one of them, some of the smaller ranges or bigger ranges, and you'll end up noticing they end up being self-similar as far as Fibonacci ratios go. So now I'll go grab the pointer, and I can take that wave and I can now move it around. So when I go back and measure the previous wave, so look here, that's how big that drop was. That's the biggest move on the chart. And when I say that we're range up, if we're running that much, there's a little bit of gas left in that tank. Not much, but a little bit. If I were to measure some of the other sizes of the cycles, this one here, bam, it's kind of nailing those ranges, ballparking that pretty well. And if we were to go by that, we're overextended. It took that just to get back to resistance, and boom. So we got one of these smaller ranges over here, and this might, I'm not 100% sure this is going to work out, but a lot of times if we add one of those smaller ranges to the equation, you'll actually see that they add up. I'm actually going to shrink it down so that they fit. Those two ranges back to back, that'll match up with some of these smaller ranges right there and right there, where it's combined, they'll make up a bigger ratio, just like the fibs. So interestingly enough, I do think it's range up, and if we were to look at where it's sitting and kind of go from like a stock in the box perspective, where it broke out, stock in a box perspective would be, well, it could run this much above resistance, which would put us up, nice little bit of room to go on the top. But if we were to measure one of the smaller ranges on that stock in a box like this, and kind of look at where the previous support resistance neighborhoods were, and we go to the breakout there, we're kind of getting into that same zone where we're running out of gas. So big fat number, 4,700, already slowing down. Candlesticks are there. And all it takes for this to retrace is trailing stop losses to get hit. For the trading computers and algorithms to start selling just because it's profit taking. So not that it would really indicate anything other than a sell off. So let's go with the Dow. And the Dow didn't clear the high, and it's already on the way. Boom. So the Dow's kind of signaling what I think we may see from the rest. Only 30 stocks there. It's already broke. Let's look at the Russell. Already in the retracement. And let's look at the dollar index. Dollar index giving in a little resistance signal, looking like it's coming down a bit. Let's take a quick look at precious metals. Let's look at gold contract. Broke key support down. I think that this would be a great opportunity to sell puts, maybe. Naked puts on the gold ETF. Let's look at the mini contract. Same thing. So you could look at like the GLD, and you've got that bullish Arami in there after a big drop and go way out of the money. So what happens here is the implied volatility shoots up, and you could go sell really expensive out of the money puts. On gold, we might see the same thing on silver. Silver also down. Boom. Good time to potentially sell trade. So there we have it. Let's take a quick look at the VIX. VIX should be low. Of course, condition to have it. VIX is low down there at the 1246, coming off of that support zone. Again, it responds to the market, but it's definitely in an area where, the old saying is when the VIX is low, it's time to go. Just meaning that the market's pretty content, had a good run, and won't be surprised to see that sell off. As you look at some of the other major indices, things like the basic materials are kind of they've gone and kissed goodbye, as did the industrials. Doing a little bit of a kiss goodbye, whereas some of the others like healthcare have been stronger, more resilient, putting in run. They're up at the top of the range, kind of like the market. So if you're looking for bullish trades, stay in bullish, stronger sectors. If you're looking for bearish trades, stay in the weaker sectors. This is Coach D with TackleTrading.com. We'll come at you later today with more fun stuff.